It's great to be here, and thank you, our panelists, for joining me today. So I think it might be worth me doing a bit of sort of general background to this discussion, just the context of where we are. So obviously, since the Paris Agreement in 2016, we've seen an enormous influx in net zero targets across the world, and across the corporate world, we've got over 90% of the world's emissions now cover the net zero target. We've got, I think, about 80% of the FTSE 100, 80% of the Fortune 500 in Europe covered with the net zero target. And obviously, within that, emissions reductions are critical, and that is what we really must be prioritizing, things like electrification, things like efficiency. But as we all know, on current technologies, we can't hit those targets alone. And so that's where the voluntary carbon market comes in. And so for those that maybe are less aware of this market, the voluntary carbon market is an unregulated market which basically allows companies and individuals to offset their unavoidable emissions. So it's sort of known as the carbon offset market as well, but for this context, we're going to be calling it the voluntary carbon market. And that's what we're really talking about today, and how risk is priced into that market, and particularly looking at insurance as well. So a carbon credit, just back to basics really, is basically a promise that a ton of carbon is removed or avoided. And the market itself, the projections are this, I think the one that is often used is by McKinsey, that the projections are about $50 billion market by 2030, which is up from around $3 billion today. So that is an enormous growth curve we have to climb. And a bit of context for me and BeZero, we are a carbon ratings agency for this market. So we rate the carbon efficacy of those credits, which ties really closely into this language, this conversation we're having about risk in this market. And to discuss a lot of these issues and much, much more, I'm really thrilled to have an excellent lineup of speakers, a sort of the who's who of carbon insurance, I think it's fair to say. So first we've got Natalia Dorfman, who is the CEO and co-founder of Kita, a carbon insurance company, has sort of 15 years in business development and strategy in the legal sector. We then have Laura Fritsch, who's the Chief Innovation Officer and co-founder at OCA, sort of also a PhD at Oxford and a fellow at the Alan Turing Institute. And then Conrad Frolic, who's the founder and CEO of Carbon Pool, which is and has a long career in the insurance sector as well. So really, really excited to have this panel here today to be discussing some of these issues. So just to kick us off, we don't have that long in the panel today, it's just half an hour panel. So just have a couple of minutes from each of the speakers, starting with Natalia and then Laura and then Conrad, just to introduce yourself and the company.
Yeah, thank you very much. Pleasure to be here. And thank you all very much for coming to listen to a bunch of insurance companies talk. Slightly more exciting than a bunch of accountants. But we can make it interesting, I'm sure. So I'm the CEO and co-founder of Kita. Kita is a carbon insurance specialist. So that, in essence, means that we develop insurance products that enable more financing to help high-quality carbon projects scale. When we set up Kita, we saw the lack of insurance in the voluntary carbon markets as a real deterrent to financing. As we'll talk through, there's significant risk in this market, and right now it is just passed between market participants. The introduction of insurance puts in place companies that specialize in handling risk, and as such, we thought that would enable more money to go to high-quality projects to achieve that scaling that we were just talking about, from about $3 billion today to about $50 billion by 2030. And when you think about that $50 billion in terms of climate, that equates to many more tons of carbon dioxide that are currently in the atmosphere getting taken out of the atmosphere, which is an essential part of fighting the climate crisis. So that is the mission of Kita. Actually, one more point. If for any insurance people, and there were a cover holder at Lloyd's, and we have an insurance product on the market right now that covers what's called delivery risk of carbon credits. And we have 2 more products that will be coming out soon, and so happy to talk through those.
Great, thanks Natalia. So I'm Laura, I'm Chief Innovation Officer and co-founder at OCA, the carbon insurance company. And we believe that every carbon credit should be insured. We went into this market similarly with the concern that there were insufficient risk mitigation products today, especially in light of the rate of scaling of the voluntary carbon market. And our first product to market is called Carbon Protect. And it essentially wraps the carbon credit with a guarantee that that credit actually led to either the removal or the avoidance of 1 metric ton of greenhouse gases. And if a number of perils would come to pass, which can be from overcrediting scenario, it can be from a cat event, it can be by virtue of methodology changes, it can be by virtue of impermanence, then we'll substitute that credit. And especially in conversation with large corporate buyers, the reputational and financial concerns regarding these credits have been a huge deterrent to purchasing. And then at the same time, a lot of the 2030, 2050 targets require the acquisition of these credits. And every advanced financial market has insurance inbuilt into the process. And as we're going to talk about later, there are a lot of parallels here into the fixed income securities market, and we believe that not only this product, but a suite of products that we're working on will help address these unavoidable risks associated with carbon credits.
Thank you. Come on.
So I'm Conrad. I head up Carbon Pool. We're a new startup. We are building out a full-stack insurer regulated in Switzerland by the regulator FINMA. We are focused on the negative emission space, like our 2 colleagues here are as well. We insure essentially any risk to a negative emissions project. So classic ones are shortfalls for biomass projects, be they afforestation or biocar or whatever these types of projects are. And we're essentially doing multi-year insurance covers against pretty much all perils for those shortfalls. And like, we're essentially trying to start an industry here of things that are largely uncovered today, and I guess that's what we're going to be talking about. Thank you.
Brilliant. Well, thank you all for being here. And so maybe to kick us off to Natalia first, I'm interested, just sort of first things first, on why do you see sort of carbon markets as being important for net zero? And then sort of twinned with that, what are the sort of key risks that you associate with them at the moment?
Yeah, of course. And I would say I used to be a real carbon market skeptic. I used to work at law firms. When I was at a law firm, I was global head of new business at the world's largest insurance-focused law firm, and we worked with a lot of clients on the regulations and liabilities that were driving them towards net zero in the carbon markets. And I used to be a skeptic of the carbon markets. I thought it was, in essence, greenwashing, which is, of course, an allegation that we hear a lot, and it is one of the risks for any company engaging in this space. Over time, I clearly converted my views, and that now I have an insurance company focused on the carbon markets, and that is because, I suppose, of a very key fact. So 1, we have too much excess carbon dioxide in the atmosphere today. Even if by some miracle we manage to decarbonize completely, we still just have too much excess carbon dioxide in the atmosphere today, and that is going to cause climate change. So 1, we need to take that carbon dioxide out of the air. 2nd, we have a much broader crisis in that we are cutting down forests, we are losing biodiversity at terrifying rates, and again, we need to do something as a society to stop that loss, to avoid deforestation, to restore the nature that we rely on for our lives and livelihoods. So when you think about that, how are we going to do these 2 things? How are we going to take carbon dioxide out of the air? And how are we going to stop deforesting and restore nature? The only way to do that is via finance. Now, obviously, we have grant financing, we have NGOs, we have other kinds of charitable donations, but those have never been enough and will never be enough. And so thus, you start to look to the voluntary carbon markets for carbon financing. And so in essence, the voluntary carbon markets are there to provide money to these projects that either take carbon dioxide out of the air or avoid putting carbon dioxide into the air. And I have come to the very firm belief that if we do not use this mechanism that exists today and can be scaled today to put significant amount of money into these projects that otherwise have no reason for being and no source of finance, we will fail completely in fighting climate change. And so thus, that's why I came around to insurance being an essential force to enable that scaling of that finance. But then in terms of the risks that companies are facing when they're looking at this space, so I'm a company with a net zero strategy. I've looked at avoiding all the emissions I can. I've looked at reducing, and I have this unavoidable chunk of emissions that are just part and parcel of my business today. So what do? I go look at the voluntary carbon markets, and I look to offset. First, I'm faced with a somewhat bewildering choice of options. I could buy from a multitude of carbon standards and methodologies that tell me what's good. I could buy nature-based carbon, trees, peatland, mangroves. I could buy technologies like renewable energy credits or biochar, direct air capture. Prices range from $5 to $800. How in the world, at a top level, do I pick? How do I know which is good? Then that leads to the second challenge. If I pick wrong, there's significant allegations out there of greenwashing. I could be put on the front page of the Financial Times as a company that has completely disregarded its own impact on climate change. And then third, carbon is somewhat, shouldn't be, but is almost somewhat inherently a difficult thing to quantify. In that you are, on one hand, simply quantifying, has a ton of carbon been removed from the atmosphere and stored away somewhere? But then also, people buy carbon for other reasons as well, social benefits, biodiversity benefits. And some of these things can be difficult to quantify at the outset of a carbon project, which can lead to things like Laura was saying, an under-delivery of projected carbon, what the project thought they would have, they don't actually end up having. Or, once I have a carbon credit and I've put it against my net zero strategy, a form of accounting, what happens if that carbon releases and goes back into the atmosphere? All of a sudden, the dollars that I spent on that project have in essence resulted in nothing. How do I compensate for that loss, and how am I responsible for that loss? And all of this is against the backdrop of a very rapidly shifting regulatory environment in terms of carbon and broader net zero. And I would say it's just a very scary place for companies to enter. And I think one of the key benefits of insurance and being introduced to this market is a stamp of confidence for buyers. Not just have they done their own due diligence that has directed their purchasing, but actually an insurance company with all of the due diligence and regulation that comes with insurance has provided a further stamp of confidence and will protect them if something goes wrong. So it's high level. There's obviously more risks than that, but I'll leave it there.
Yeah, that's brilliant. Yeah, I mean, it's that point around quality in this market is crucial. And shameless plug, but BeZero Carbon has 300 carbon ratings, currently publicly available on our website. So if you're interested in this space, please do go and have a look, and hopefully that will help you in making those decisions. So maybe to follow up from that, Laura, I'm interested in those different tools we have to assess risk in this market. Obviously, insurance is one, but I'm particularly interested in also the parallels that maybe some of our audience might know now in financial markets, and some of those tools that you could maybe use from there that are being used in this market, and how might they function?
Yep, great. So like I mentioned earlier, there are a lot of parallels with fixed income securities specifically. And broadly, and this will be very broad, I think the products that exist in the market today, or the tools, exist in kind of three main buckets. And I'll talk through them roughly in terms of date of emergence. So the first bodies that came as some form of risk management in this market were registries. So what are registries? They're essentially standards bodies that dictate methodologies, and a developer that develops a project goes to a registry and essentially lists their credits on the registry, and that is the signal of quality. The vast majority of the registries today also manage what's called a buffer pool. So what's a buffer pool? As the name would suggest, as a kind of mandatory feature of the registration process, different developers have to donate what's generally roughly 20% of their credits to this communal buffer pool. And if a list of limited perils were to pass, credits would be retired from that buffer pool. So that's two main roles of registries today. Then the second bucket are ratings agencies like BeZero, which are more nuanced. So it's not just a binary, is it registered, is it not registered, but it is nuanced, data-driven assessment of the underlying risks associated with these projects. That's an invaluable tool, especially for both traders, investors, and for corporate buyers as a due diligence tool. And then the latecomers to the game, insurance, kind of stacks on top of those two, and actually removes the risk that's currently sitting in corporate buyers' balance sheets or developer balance sheets, depending on what point of the carbon credit life cycle we're talking about. And those kind of three different types of organizations work together to not just add credibility to the market, because as Natalia was saying, the carbon credit market is one of the few as an economist, this baffles me. One of the few financial markets in the world where price doesn't actually signal quality or is a very, very weak signal of quality. And that was a huge motivation behind our product and, again, our decision to go full stack, to be able to adapt the project to the very changing needs in this space.
Brilliant. Yeah, I think it's a really interesting point you make there, because actually Natalia and I did a paper recently basically talking about the 3 pillars of integrity in this market, and they were basically MRV, ratings, and insurance. And I really think we need to make sure all of those are robust if we're going to try and get to that scale that we need to hit our climate targets. So maybe, Conrad, just coming to you now on like insurance in this market, it'd be good to get a kind of a broad overview of what there is out there. I know it's not going to be a lot, but just for the audience, yeah, just a bit of an idea of what insurance products there are for the voluntary carbon market.
So thanks, Ted. Well, I think the 3 of us are probably the only ones that are actually sort of talking about genuinely dedicated insurance products. I spent my life in the insurance industry, and I don't think there is any meaningful insurance products in this market right now. There is some sort of analogies. So there's definitely a push for parametric covers. So these are sort of weather derivatives that will pay out if your project or whatever it is that's exposed to weather has a bad turn of events. But in terms of classic indemnification, there is nothing really out there. And there's definitely nothing out there for a multi-year period. One of the challenges that the insurance industry has, it is a very heavily regulated industry. And taking, in particular, market risk on your balance sheet with these prices that are all over the place, taking market risk on your balance sheet for, even for 1 year is very onerous, but let alone doing it for 2, 3, 4, 5 years. It's just not something that insurance companies are willing to do. And I'd say the last challenge that the insurance industry has faced is it is very new. There is not much claims history. There's not much experience of damages being done. And insurance companies have traditionally liked to first look at, well, what's the damages that are done, and then to sort of looking in the mirror, basically saying, well, that's what's been happening historically, therefore this is how we're going to price your insurance right now. We're sitting here at the beginning of an industry with no meaningful claims information, and so it's just very difficult for the insurance industry to get started and to sort of go forwards looking instead of doing the normal backwards looking that we've been doing. But I think the 3 of us are trying to do that.
Brilliant. Thanks, Conrad. And Laura, maybe coming to you on this next one, I'm interested in this idea of self-insurance, and you touched on it a bit there, but buffer pools in the voluntary carbon market, which is this sort of imperfect mechanism that currently exists. One stat I think is quite astonishing is if you look at the Californian regulated market, the buffer pools there, they put aside the credits for an 100-year period, and in 7 years, that buffer pool has gone. And that is what the wildfires will do, and it sort of just illuminates some of the issues we've got in there. So I'm interested in your take, and maybe we could actually come to Natalia after that, and then I'm sure, Conrad, you've got thoughts about this as well. But that non-permanence buffer pool, that risk that they're trying to deal with through the buffer pools, like what do you see as those key limitations, and how will the new tools like insurance and potentially how ratings fit into that, how will that help?
Yeah, absolutely. So there are 2 different categories of buffer pools that exist today, and I'll talk about them collectively afterwards, but just for distinction for the conversation, there are buffer pools voluntarily created by developers to essentially address some of the concerns from buyers at the point of acquisition. And then there are the larger buffer pools managed by developers that I had previously described, which are a feature of registries that are a feature of the registration process. And I could talk till I'm blue in the face about the problems with buffer pools, but I'll try to keep it short and sweet. And for the insurance folk in the room, Lloyd's of London Maritime Insurance 200 years ago figured this out, but somehow the carbon market still uses buffer pools as a risk mitigation strategy. I think the 3 main issues with buffer pools as it pertains to the VCM. First, from just an economics perspective, it is because all these carbon credits sit in kind, and over time that just becomes essentially a growing liability on the registry's balance sheet, it can't be reinvested. And with growing climate risk, that's extremely concerning. And just unsustainable. Then from just a conflicts of interest perspective, today, in the case of the registries, the same body that's a standards body also manages the buffer pool. So there's actually no real incentive for you to increase the standards of registration if you know that that would just lead to a quicker burn rate of the buffer pool. And then just from an interest perspective, because at the decision of the magnitude of the contribution to the buffer pool is not actuarially based or scientifically based. So there's no inbuilt incentive to want to develop higher quality projects that in the case of insurance would command a lower premium than enter insurance. All of these problems essentially go away. And it's one of the few situations where it's actually a win-win to all the parties involved. So insurance fixes the economics problem because the insurance premium can actually be reinvested, and that creates a situation that's a lot more sustainable over time. And with reinsurance backing, you're essentially offsetting the risk of a portfolio of carbon credit projects with a portfolio of other risks that are completely uncorrelated with carbon credit projects. Then from a conflict of interest perspective, if the insurer manages the risk and the standards body manages the standard, which is what they were created to do, then that's a lot more, that's beneficial from a risk mitigation perspective. And then just, again, from a incentives perspective, if a higher quality credit, a higher quality project commands a lower premium, you're both incentivizing companies to buy those credits because they'll be seeing the premium and seeing what that actually means from a purchasing perspective, and incentivize developers to go through the process of making sure that their credits are commanding a lower premium. So the buyer is protected, the developer can actually sell the 20% of the credits that were sitting in the buffer pool that get released to the market, and the registries do what registries are supposed to be doing. It's a win-win.
Yeah, so there's a lot of issues with this mechanism, and I think I'm interested to get to, I know that all of you probably wouldn't want to set this up if you thought, set up your companies if you thought buffer pools worked in the way that they're supposed to. So I'm interested maybe firstly with Natalia on a similar question, but also I'm interested to know how you feel buyers and people in the market respond to buffer pools, and whether you think that there's a sort of growing consensus that it needs to be replaced with insurance.
In complete honesty, and I don't know the people in this audience, your level of knowledge of the buffers or how you engage with the voluntary carbon markets, but I would say at a broad level, I think the vast majority of people don't understand the buffers. Just actually have absolutely no idea how the buffer works, why it's there, and what it's really intended to do, and then how it actually does that thing. So I guess two examples on that. One thing that I think isn't well understood in terms of how the buffers would operate, and this is noting that the buffers are broadly speaking very untested, but it is a problem. Buyers tend to buy, I think, what you almost call stories in the carbon markets. So while 1 ton of carbon should be 1 ton of carbon, it should be a fungible thing. That's not how people think about it. I might have a very specific strategy. I believe in enhancing biodiversity and local community benefit in the global south. And so I am very specific about the type of, let's say, afforestation project I'm going to buy in Peru. And that is what I want. The problem with the buffer pool is if I get those credits and something happens, so in insurance language we'd call it a reversal, but in normal person language, to say there's a fire and your trees burned up, I don't get back the carbon that I wanted. That is the carbon that I've told everyone in the world is linked to my net zero strategy. I'm not getting back that afforestation project in Peru. I might get back a cook stoves project in a completely different part of the world. I might get back a renewable energy credit. I might get back any old thing. I don't get to choose. And I think that is one of the key problems with the buffers that, again, insurance and proper risk management could help, is the liquidity that Laura talked about. I think it could certainly enhance the liquidity. But it can also help with paying people back with what they wanted, or the closest equivalent to what they wanted. And I think that is both a key misunderstanding of the buffer and a key benefit insurance could potentially provide. And then I guess just the final point that I'll make in terms of just the buffers generally. With KETA, I think the buffers are quite complicated. So we actually started with another misconception in the market, which is where you're taking a risk that isn't yet protected in the buffer. So what we insure right now with our product on the market is what we call delivery risk. So it's for people who are basically recognizing there's not that many high-quality carbon credits out there in the world. and the price is expected to rise. So if I wanted to lock in supply today and lock in my price, I put down money into a young carbon project before I actually receive what would be called a verified carbon credit, a credit that's been audited by the carbon standard. It's only once the credit is audited and verified that it goes into the buffer. So if you're at that pre-investment stage, you're putting down money up front, you're expecting carbon later, you're not protected by a buffer. You're literally completely unprotected. And so that's where we focused our first product.
And Conrad, just coming to you, firstly, I'm interested just on that same point around buffer pools, but I'm also, just from your perspective, we don't have much time left, but how do you see the sort of credit ratings, carbon credit ratings, and insurance interplaying in the future as well?
All right, so on buffer pools, I mean, these were great points. I would make one additional comment, and this has come up in some conversations we've had from Carbon Pool with ratings agencies, is they are, clients, end users are perceiving these buffer pools as insurance, but they are not insurance. And they are beginning to get sensitive to the risk that they run, that at some point some regulator is going to come down on them and say, you're selling insurance with no capital. And that's a really awkward situation to be in as somebody who's trying to make that pitch that you're insuring them, but it's not insurance. So I think there's definitely a nervousness within the agencies around whether they can continue this way or not. On the ratings agencies like BeZero and insurance, look, I think in the insurance industry, we use ratings a lot. I mean, basically credit ratings for obviously for credit risks. I think what's interesting, in particular for investors and people who are buying credits, is to use ratings to get an independent view as to the qualities and the risks associated with those ratings. I think as an insurance company, we would always like to think that we know better, and so we will build our own models, which should correlate with your models. But if we would just base it on your models, then obviously there would be no secret sauce to our risk assessment mechanism. So I think that they tend to be quite correlated. So the way insurance companies see risk and ratings agencies see risk is quite correlated, but they are different. And there's reasons for those differences as well, which I don't need to go into right now, but they will be slightly different.
Brilliant. Well, thank you. I'm afraid time does fly when you're having fun with carbon insurance, so we are out of time. But thank you so much for joining us today, and thank the audience. Yeah. Cheers.
Thank you.
Thank you.